Welcome to the Big Skinny with me, Lou Basenese, coming to you live from our Brooklyn studios today. And if you're wondering why I'm dressed in black, I gotta be honest. I'm gonna be a Debbie Downer to start because I need an upper after this. I attended a funeral of the dad of a great childhood friend, and man, life is precious. You gotta cherish it. You gotta love the ones that are close to you, near and dear. And just remember, Andy Dufresne, Shawshank Redemption, we got to get busy living or get busy dying. So we're here today to get busy living with what matters in the financial markets. If this is your first time joining us, you might be wondering, what the hell is the Big Skinny all about? Well, let me tell you, we're about all filling, zero fluff. Well, there's too much fluff in life. There's too many news headlines. There's too many investment ideas. And we're here to sort through all that noise and try and bring you actionable investment insights. Some people have called us the Sports Center of financial news. I'll take that. I like that ring. I like to think of us as Dave Portnoy of pizza reviews, except for investing news. So everyone knows Dave. One bite. Everyone knows the rules. We've got our own rules here. Each week, I bring you 3 topics that really need your attention. And we do it in a predictable format of one headline that you should usually ignore, one chart that gives you the key data that you got to be paying attention to, and one investment insight to make sure that you can turn this information into profits and increase your bottom line. Because let's be honest, folks, if we're not making money together, we're not going to be spending much time together after all, because that's the whole purpose and goal of this investing business. So here's the other thing. After we get through the rundown, we bring in some guests because we know that in these markets, you have to be humble or you're going to be humbled quickly. So we bring in expertise from wherever we can find it in areas that we know we don't have it. And I'm excited for this episode because we have not 1, not 2, but 3 experts that are going to be joining the show. First and foremost, we're welcoming back Eric Jackson of EMJ Capital. I hope everyone here listening today was here the first time he joined us on the show, June 30th, because he made it count for everyone. The 3 stocks that he shared with us, up a collective, well, not collective, individually 77%, 87%, and then a whopping 1,092%. We're going to talk about those stocks and more, and why there's plenty more room to run, and why this retail revolution is not meme stock mania, it's actual paradigm shift in the markets. And then we're going to move on to our next guest, George Brandon of MDB Capital, and Howard Lupert of Caretsu Forum, that are changing the game, another paradigm shift happening across angel and venture investing. So we're bringing all to you today, folks, the things that are changing in the markets, making this all about how you make moves to make more money. All along the way, we're streaming on multiple social platforms. We want you to join the conversation. Yes, that's right. This is an interactive show. I grew up back in the 80s and 90s. We had those choose your own adventures. So please, let's go. Dragon X Jackson's here, and he's going to be bringing the heat. I'm going to be trying to keep up along the way. But please ask your questions, your biting criticisms, whatever you may think needs to be shared. Make us respond, and we'll do that. We'll oblige. And with that being said, well, let's get to this week's rundown. Hate the Eagles, but love the city, love the art museum there, and love me some Rocky, folks. Let's throw some punches here. Coming down to this week's rundown, your help is not wanted, apparently, based on the latest labor data. What does this mean? Well, leave it to the folks at Bloomberg to kick up the clickbait and fear-mongering with this headline saying the stock market's fate comes down to the next 14 trading sessions. Really? Melodramatic much? 14 trading sessions are going to decide whether or not this stock market continues or not? What in the hell are they talking about? Well, they're trying to scare you that there's data coming before the next Fed's meeting that could really undermine this entire market rally. Well, I've got news for you, folks. Let's start with the truth and not this headline. The truth is the labor market is absolutely cooling. The latest jobs data that came out shows that, yeah, even with revisions, we actually had a negative month in June. You see the trend here, it's coming down. And I've been saying this, I've been a hawk, meaning I've been adamant that the Fed should keep rates higher for longer, with one exception, if the labor market cooled, because as the labor market goes, it can cool gradually and then suddenly deteriorate. And if we look at another data set, you can start to see the trend more clearly here. If you look at the annual trend in monthly average gains, it's clearly going down here. So look, 380,000 ads per month back in 2022, and now we're down to about 75,000. So there's no arguing here. The labor market is in almost a tailspin. So what does that mean for the Fed? It means the Fed's going to have to cut sooner, not later. Against the backdrop, though, of strong economic growth. I mean, everyone remembers the Atlanta Fed that came out in the beginning of the year and freaked everyone out because of the tariffs and trade wars and said we were going to have a negative 1.8% GDP print in the Q1. Guess what those Atlanta Fed folks are saying nowadays? Looks like we're going to have a 3.3% growth rate for Q3. So the economy seems to be humming along. The job market seems to be waning. Inflation is tame, or as my buddy Brian Brenberg from Fox Business said, look, growth at 3.3% in the second quarter, yeah, that's not bad. It's another contra-panic number, and the inflation numbers really haven't been that bad either. So what gives, folks? What are we to do? Well, the Fed's absolutely going to cut. They're going to be left in a position where they don't have a choice because they have a dual mandate, full employment and keeping a lid on inflation. And full employment looks like it might be out of the question right now if they don't act soon enough. But what gives? Is the economy humming along and yet there's not enough money to hire new employees? Is the economic growth really in jeopardy? No. And that's what this week's money chart is all about. Follow the earnings, as we've always said here. Earnings ultimately drive stock prices. And if you look at corporate earnings across the S&P 500, they've not just been good, they've been great. I mean, I don't care if you want to focus on the Mag 7, 2 quarters in a row, 3, 4 quarters in a row, 5, actually, as I look at this chart, above 25% earnings growth. And then look at those wonderfully unmagnificent 493 reporting solid earnings growth that's going to accelerate in the back half of the year and into 2026. Something that is not immediately evident in this chart that I can tell you from studying and nerding out on the data. These are the actual numbers that came in through Q2. Guess what the estimates were? For about half that, right? So analysts are dramatically underestimating the strength of corporate profitability and growth right now. The economy is not on the brink of a recession like many fearmongers want us to believe. All is well, and it's going to get even better as the Fed cuts rates and provides an extra oomph to this market and hopefully the real estate market, which is an important one that we got to bring up. So what's bringing about all this profitability? Well, and in light of the fact that there's a stalled out labor market, well, it's AI and it's the boom and it's not going to go bust. That's the next topic in our rundown here. We're getting headlines now increasingly that I'll give them credit. They're not completely wrong. The folks at Business Insider saying the AI hype is crashing into reality. Stay calm. So what's right here? Stay calm. That's right. The other thing, hype crashing into reality, that's not true. Folks, hype means there's no substance behind it. It's just a lot of talk, no action. And I'll confess, there's a lot of talk about AI. If you scan corporate earnings reports, you see a record high mention of AI on earnings calls here for the S&P 500. Almost 300 out of the 500 companies can't stop blabbering about AI. Well, here's the other thing you realize, though. It's not just talk, it's action, right? These companies are actually spending money on AI, and you've got to look at this from an earnings result standpoint. I mean, no better than the big leader of the AI trend, Nvidia. What are they doing? And this is coming from Ross Gerber, who I gotta confess, we used to butt heads a lot on CNBC. He used to be an early Tesla bull and Apple bear, so they had an innovate or die, and they ain't dead yet. And well, Tesla looks like it might be going the wrong way. But anyway, he's dead right about Nvidia here. This is a $4 trillion market cap company, the leader of the AI race, and putting up numbers like this. 56% revenue growth. This trend is nowhere near ending, and that brings us to this week's money chart. So we look at Nvidia, the stock chart's going up, but look at spending on AI. Talk can be cheap, but hyperscalers mount up. The actions speak here. You see, not only is Amazon, Meta, Alphabet, Google, and Oracle spending huge. This is not even all the spending that's going on in AI, but it's going up and to the right. We're talking about roughly $1 trillion between now and I don't know, the next 2 years before 2030 for sure. So that's a lot of spending that's not going to be happening haphazardly. So would you rather believe the media types that are warning you of an imminent collapse, or would you rather believe the insiders that are allocating literally $100 billion budgets to make this trend a reality? So the investment takeaway, keep investing in AI, keep investing in Nvidia. We have a list of top 10 stocks not named Nvidia that are a way to play the AI trend. We're going to give you 2 more AI stocks before the end of this episode, so stick around for that. But right now, let's get to the third topic in this week's rundown, the retail revolution, because this is what matters. Meme stocks are back again, according to the headlines, and it's going to end just as bad, except it's not going to. That's what everyone wants us to believe. They think this is the latest meme stock mania when we look at runs in companies like Kohl's and Opendoor Technologies and even the Bitcoin miners that are pivoting to high-powered compute. right? Forbes, I'm sorry, but you got it wrong again here. There's a difference, and this is the thing. Wall Street is like the traditional Wall Street gurus are like a kid looking through a kaleidoscope and trying to get a clear picture of what's ahead. They just don't get it, and they're not gonna get it until it's too late. They think the retail money is just dumb money, but I'm gonna rename retail to self-directed, because there's a lot of self-directed investors now that are in this retail army, that are sophisticated, that are talented, that, man, they have access to information. How big is this retail army, you ask? Well, just pay attention to Robinhood's CEO just telling you that there's more millennials. Yeah, they're younger. They skew to a younger demographic that are on Robinhood than Schwab, Fidelity, E-Trade, and Vanguard combined. Now, think about this. Robinhood stock is a darling of the stock market right now. It's not just based upon this millennial boom and a boom in trading. What I want to tell you is this is a true paradigm shift. So Main Street, I mean, the old guard on Wall Street doesn't want to believe it because they think that we're just dumb money and that we're going to lose when we trade. But look, Robinhood joined the S&P 500. That's legitimate. They have over $200 billion in assets under management, right? That's legitimate. That's real capital, real power. And here's the thing, it's got staying power. Now, the old guard would like to tell you that, no, look, you look at this chart here from Goldman Sachs showing a basket of meme stocks has done the best in the market this year. Non-profitable tech has done the best, but guess what? This was the case coming through the COVID days as well, and yet anyone that's been in the markets long enough knows if you try and day trade and not actually invest in fundamentally strong companies, you lose. 97% of day traders are unsuccessful. That's right, 97%. This chart shows it. 1% lose money, and then 2%, they don't know exactly how many profits they make. They can just stay in business to keep trading. But we're not seeing day trading. This is a retail investing, long-term investing revolution, and it's showing up because it's not day trading numbers. It's not Robinhood account balances. 401k balances are showing that the younger generation has over 90% in equities. They get that the inflation hedge, the greatest inflation hedge of all time, has always been equities and will continue to be. They get that the information edge has totally changed on Wall Street. There's readily available information that can be spliced and diced and then disseminated in a way that was never before possible thanks to social media. So I'm here to tell you that the retail revolution is not just a meme stock mania 2.0. This is a true paradigm shift on Wall Street where self-directed investors make up almost 40% of daily trading volumes on equity markets, sometimes as much as 25% in the options markets. We're here to give you a run for your money, Wall Street, and we're going to do it in ways that you have to figure out how to work with us or it's going to work against you. And that really is the focus. The key takeaway here is there's nothing stopping you, no matter if you've never made your first stock investment yet today, or whether you've been making your own investments. Over time, the money chart shows there's going to be a huge transfer of wealth. And these younger generations, good old Gen X, my generation, millennials, there's going to be a transfer of wealth, and they're not going to have it managed by your financial advisors. It's going to be managed by themselves, self-directed, or they're going to follow gurus online that actually put out unbelievable content. I mean, I'm thinking of young people that we've had on the show. Shai Balor, right? He's not a traditionally trained Wall Street analyst, but puts out some of the best content out there. Sam Badawi, I think that's how he pronounced his last name. His Twitter handle is Sam Solid. Guy does incredible fundamental analysis. You have the Fibonacci Princess that does technical analysis. There are people out there that you can learn from starting today. And hopefully we're one of them. And that's what we want to get to next. So the investment future is bright if you're a self-directed, dumb money retail investor. And we're going to bring in a guest right after this break that's going to walk us through some of the best investment ideas that we can focus on right now as this retail mania and revolution takes over Wall Street. But first, a quick word. Don't forget to go to our website, thebigskinny.com, and sign up for our newsletter or scan the QR code on your screen. That's right, thebigskinny.com, where we serve up the insights one headline at a time, one compelling chart, and one investment insight to improve your bottom line. And now, just a quick word. Do you believe everyone deserves access to quality health care regardless of their financial situation? Well, at the Roberto Clemente Health Clinic, we make that a reality. And I say we because I'm on the board of directors of this US-based 501c3 nonprofit, and we're dedicated to providing affordable, compassionate medical care to 30,000 people living in the coastal communities of Nicaragua, the second poorest country in the Western Hemisphere. Now, as a member of the board, I've seen firsthand, and so has my family as we've traveled down here multiple times a year, the profound impact the clinic has on lives, providing a full spectrum of the things we take for granted here in the U.S. in medical care: primary care, pediatric care, urgent care, and just wellness education and services. So I know there's plenty of things that clamor for your time, attention, and donations. I'm not begging you in any way, shape, and form. All I'm asking you is, if we've made you any money here in any of the names that we've talked about, the AI stocks, the stocks that Eric Jackson has brought, or stocks that other investors that have joined our show have shared with you, just take a look at the Nika Clinic and the work we're doing there. All we ask is that you find out more about what we're doing so that together we can make a difference in the lives and those that have less fortunate access to what we take for granted. We'll be right back with Eric Jackson.
Appreciate it, Jared. Lou, your thoughts on the trading action
Yeah,
today?
I really want to see some follow through tomorrow, because this favorable ruling for Alphabet really removes a major regulatory risk from the entire big tech sector for the Mag 7. Want to see if that can follow through. Alphabet has more room to run. It's the cheapest of the Mag 7 stocks at about 20 times earnings. So I think this rally continues for them, but does it carry through and have a halo effect on the rest of the sector? And then energy is a key focus point for me. Oil down another almost 3% today. I would argue, and this is a contrarian stance, Goldman Sachs is out saying oil's going south of 60. I'm telling you the sweet spot for most producers in the U.S. is between 65 and 75. That's what they need longer term to profitably produce oil. We're going to head back there gravitationally in the next 6 to 9 months, I believe. That's not priced into this market. That would be slightly inflationary. But I agree with the previous guest that AI is a huge deflationary balance to any re-inflation.
Well, it was interesting. We were talking together to Mark Newton, the great technician, chartist. He sounded broadly constructive, not just when he was talking about the charts, Lou, but I thought it was interesting with Mark. If I'm paraphrasing, he kind of said, listen, earnings solid, economy's hanging in there, Fed cuts on the way.
Yeah, earnings are the most solid thing that people are underestimating. If you look, the estimates for this quarter going in right at the start of the quarter was for about 4.9% earnings growth for the S&P 500. It came in at 11.9%. This is the second quarter in a row that actual results bested estimates by more than 2x. So I think this is a very good harbinger of the underlying strength of the economy and corporate profitability, and that translates into higher stock prices down the road.
All right, let's talk more.
You've got a couple of healthcare stock picks. Go.
Yeah, cheapest sector in the market, most undervalued, most underperforming. Becton Dixon, think of consumer staples, but hospital staples. They make all the equipment that you use in every hospital setting. Very undervalued at about 17 times the earnings. Could be a very resilient play no matter what the market does.
Okay, there's another one, and you've brought this one up before. Halozyme Therapeutics.
Halozyme, I'm banging the table here for people to buy before it's too late, just like it was with Google. This stock's up about 30% on the heels of really strong earnings again. Sales were up 40%, earnings up 77%. They have a technology that takes infusions that can take up to hours to administer drugs to have them done in minutes via injection.
I like the sound of that. All right, Lou, thanks very much for being here for the hour.
Always a pleasure.
So.
Welcome back from that quick break at the Big Skinny. That's right, you're in the Matrix. That really wasn't a few minutes long. That was really short. We had some technical difficulties. It's nothing different than going to a hockey match and the Zamboni comes out on the ice and just takes the time to clear the ice and smooth it off. So ding, 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 here we go. I'm excited to, this is why we're here. We got to make sure we can get our guest on. We had some technical difficulties on our end, but we pushed through. Perseverance is the name of the game because there's money to be made here, and that's what Eric Jackson's all about. If we bring up this chart here, we show his performance. I alluded to it earlier, but Eric Jackson can't be beat as far as I'm concerned over the performance in the last 60 days. IREN, which we talked about, remember we had recommended Core Scientific, got bought out by Core Weave, and we were looking for replacements. IREN was one that we invested in that Eric put us onto as well, confirmed that thesis. Cypher mining as well. Cypher up 77%, IREN 87%. And then Opendoor Technologies, the standout performer in the last 60 days, up from a low of 51 cents to north of $6. And that's why I want to bring Eric Jackson back on to talk about this outperformance and what he thinks is ahead. Because, folks, the good news is if you missed the boat on Opendoor, it's not too late, right, Eric?
Hey, Lou. Good to see you. No,
good to see you, my friend. Way to persevere with us. I really appreciate your patience, and I know there's a lot of people here that can chime in at any time during this conversation and ask us some questions that are looking for your latest takes on this too. But for the benefit of those people that might not have been paying attention to, maybe they pulled a Rip Van Winkle and spent too much time putting marmalade on their bread and eating breakfast, don't know what the thesis is for Opendoor Technologies. Can you share it with us? Elevator pitch for Opendoor.
Sure. Just like we've seen Carvana disrupt the traditional way of buying and selling used cars by going direct to consumers via an app or a website instead of having to deal with a car dealership. Opendoor is trying to do that for buying and selling your house and basically bypass the traditional way of doing that with agents where you have to end up paying them a 6% commission rate for selling your house. And then you're left scratching your head wondering, like, why did they deserve $40,000 out of this transaction? So the Opendoor is trying to disrupt that, make the cost of buying and selling homes cheaper, make it faster, have more certainty attached to the price, and basically, it's one of the last big markets out there that can be Uber-fied. Basically, like we've seen it for Airbnb, we've seen it for Uber disrupting the traditional way of taking a taxi, but buying and selling your house is a huge market. It's a $20 trillion market just in the United States alone.
Yeah. So this is, you're coming in a little scratchy, but to make sure people hear.
So if Opendoor can get it right.
This is the last huge market that needs to get disrupted. I know, folks, this is the difficulties we're trying with here to try and get the information straight to you from Eric. Yeah, well, right now we're gonna share this pitch with you directly. So Opendoor Technologies, as he was saying, one of the last large markets to disrupt. Why do you need to go through the old school of brokers and tons of transactions and paperwork when you can handle it all in an app? If you think about it, everything in life is being consolidated, right? Rocket Mortgage was consolidating lending down there. Eric, can you hear me now? Yes, maybe. This is the Verizon commercial. Can you hear me? Can we hear him? Well, we're going to work to get Eric back on the line, but folks, do not be deterred. There's plenty of information here that we want to share. I don't know, something's in the ether that doesn't want him to share this investment case for a stock that can go from 51 cents up to $82. You've been paying attention and following along. The big thing here is it's a real estate play, right? So we're now talking about at the beginning of the show that the Fed is poised to cut interest rates, which is what is desperately needed for this real estate market. If you've been reading the latest headlines, buyers have been backing out of deals. The last stat I saw, there was about 70% of people that were waiting for interest rates to come down and prices to come down before they make an offer. The average age, the median age of a new home buyer are rising significantly. If you go back 30, 40 years, it was somewhere around, I think, 23, 24 years old. It's now north of 36 or 37 years old. So there's a fundamental problem in the real estate market. I'm not sitting here suggesting that a cut in interest rates would be the miracle cure, a silver bullet, by no means, but it would get things re-energized and moving in the right direction. It would also re-energize Opendoor's business. And that's really what this is. This is a stock that was a high flyer that came back down, a disruptive platform and technology that is poised to continue to disrupt that. But we need that pivot point, that turning point in the overall market that they are serving. So that's the investment case here. Look, you've seen it. I mean, $6, another run. You can have an easy 10-bagger from here if it gets to Eric's profit target of 82. That was a few years out. I'm hopeful when we can bring him back on the line, and we may have to push it to another week. These things happen, but you know, his $82 price target was a few years out. There are certain things that can happen that make that come in and that price target be much sooner. For instance, the integration of AI. And I would tell you, if anything's been shown in this market and what he's been doing in terms of catalyzing visibility for this stock, this business model, the potential, there's a lot that could happen quickly. He had a CEO that failed to respond to shareholders. I think a lot of public company CEOs are missing this point. This is a historic moment. And a retail army of shareholders who have just as much right as institutional shareholders demanded more visibility, more transparency, more information from the CEO, and she was forced to resign because she wouldn't do it. She wouldn't do media interviews. I'm sorry, but that's part of the job description. You can't just wait forever and issue press releases. You got to go out and talk to your shareholders. I'll give Opendoor credit. The board made the right moves. She resigned. They've found ways to start communicating with shareholders. They've formed their own website to be transparent, but there's a lot more work that can be done. I think Eric Jackson should be added to the board of directors. Anthony Pompliano, Marcus Lemonis are out there advocating similar things. That this happened just to catalyze change. And we all know this. The business world is dynamic. If these changes don't come quick and fast, you're going to miss the opportunity. So folks, I just don't want you to miss this opportunity. I don't want to miss an opportunity to steal information, that's not right, steal the thunder from Eric Jackson. So we're going to wait for a time when we can figure out the technical difficulties on whatever end they may be and bring him back if he'll be so gracious to rejoin us, or maybe we'll just pre-record like we did the last time. So with that being said, we're going to take a quick break, but make sure you check out IREN, Cipher, and more importantly, Opendoor Technologies. Those are stocks that I personally own, personally believe in, have been profiting from, and so have you, hopefully, along the way. And if not, then hopefully you will start tomorrow morning with the opening bell. After this, we'll be right back. We're going to take a quick break and bring in two individuals that are disrupting another phase of Wall Street when it comes to early stage and venture investing. Thanks for joining us. Stick with us because we've got more stock picks and information coming right your way right after this.
I think the big issue that I have in this particular instance is ultimately we want these businesses to thrive and we want workers to make more money. And $7.25 is not a livable wage. We need everybody to have a livable wage for the environment that they live in. In Olathe, Kansas, it doesn't cost $30 an hour to survive. A business needs to survive. In New York, it probably takes more than $15. Let the market sort of dictate how it all works.
The free market needs to, I mean, at face value, this sounds like a wage floor, sounds like a great idea, but it's really a trapdoor for the workers, as we've espoused here. It's going to lead to higher prices. But even more important, you said it in the intro, the rise of automation, right? Businesses are dynamic. CEOs have to adjust. Every 10% increase in wages, we see a 3 to 5% increase in automation and robotics. We look at these service industries. I mean, countries like South Korea don't have any people that man the registers, right? That is absolutely fully automated. That can happen here like this. We shouldn't make it happen faster. I think, as Marcus was saying, we have to create opportunities for people to make more money, a livable wage. Minimum wage is not a livable wage. We have to give them.
Well,
Welcome back to The Big Skinny with me, Lou Basenese, here with the host with the most troubles today, apparently, but we're going to bring that and turn it into opportunity. Talked about those public markets and those opportunities in small and micro caps that are yielding results. Now I want to move to another facet of Wall Street that has largely been excluded from retail investing. I'm talking about pre-IPO, venture, early stage investments. The best way to do it has been through angel investing, but you've also had to have access. I mean, if we pull up the data, if you look, or I ask anyone, who are the best performing venture capitalists out there? Well, it's a short list. The top 25 are names that we would never get access to. The minimums are too high. The clubs are too exclusive for us to get into. But guess what? Those top-notch VC firms earn the best returns. So what's the point, right? If you look at Accel and you look at all these names here, Meritech, Founders Fund, BCV, Norwest, you're looking at NEA. I mean, you name it here. I mean, tell me how many invitations, Kleiner Perkins, you've gotten to invest in these funds. Folks, most average day investors like us don't get them. And guess what? If you look at the performance of the last decade, the vintage of 2010 to 2020 venture funds, you see it's heavily skewed to this exclusive club. The rest really don't make money, and your money is tied up for a ton of time. So the performance isn't great. The 12-month gain in aggregate is about 11.5%. And get this, almost 50% of funds have lost their value. How would you like that if I came to you and said, do you want access to the best, most compelling new technologies? And guess what? We're going to tie up your money for 7 to 10 years. And guess what you're going to earn on that? 11.5%. And you're going to lose out on half that. So sorry, folks, the model is broken, just like the Main Street to Wall Street, smart money, dumb money model is broken. And Main Street is taking over. And I'm excited to welcome two guests that are, I'm going to say it, they're pioneers in letting Main Street take over angel and venture investing and do it in the public market. So without further ado, I'd love to welcome my friend, lifelong friend, former colleague from NBB Capital, George Brandon, and a new friend in this venture investing game, Howard Lupert of Caretsu Forum, the regional president for the Mid-Atlantic. Welcome, gentlemen, to the show.
Thanks for having us.
Yeah,
thanks, Lou. It's great being on.
Yeah, good to see you, my old friend. Here, I'll start with you. What you've been in the markets a little bit longer than me, right? That's just being polite. You've seen it all, right? You've seen a transition. What, from your mind, what is the transition that's afoot, and how are you guys catalyzing that to really bring about new opportunities?
Well, I mean, I think, Eric, or your comments prior to Eric coming on were pretty accurate. I think we're about to see a renaissance in not only retail, but microcap, IPO, small cap investing and market activity. And one of the problems we've seen in the last 25, 30 years is we went from 8,000 companies that were public down to 4,000. They got cut in half. And that's not a good thing for innovation. And so I think really what we're looking at with AI, you said the last market is real estate. I really think the last market is going to be legal and accounting and professional fees.
I agree that auditing, all those things, a lot of fat in those businesses for sure.
I mean, the reason companies don't go public is because it's so expensive to do that, on the legal fees and the accounting fees. They're going to get gutted.
Yeah.
There's a big change afoot. It's the Charles Schwab of legal, the Charles Schwab of accounting. And so I think right now, with the reason we partnered with Caretsu, and we'll let Howard talk a little bit about why Caretsu, but we've been doing public venture. We go from idea to IPO within 12, 18 months. You know it very well. You've been involved with a number of them, and it's about ready to accelerate.
So let me put this in layman's terms too. So this is basically, we're talking about a flood of new opportunities coming to the public markets at an earlier stage than ever before. Howard, you've been an expert incubating new companies, new technologies, and doing it traditionally through an angel investing route, which is investing small checks very early on. Tell us your experience. I mean, you've had great success, but why this partnership with MDB Capital to bring these companies public earlier now? What is it, a performance issue? Is it a structural change? What do you see that's really the opportunity here?
Well, the single greatest problem we've seen that started just before COVID is an exceptionally long slowdown in exits from our portfolio companies that we invested in that expected to see liquidity in 5 to 7 years, in some cases are now 12, 13, 14 years out. The problem with that, the companies are still alive. They're struggling a little bit, but they're still alive. But the problem is that the investors are now on the sidelines because everything that they had planned to allocate in early stage investing is tied up in these companies. As a result, late last year, we added to our investment due diligence model the fact that we were looking for companies that could tell us three things above and beyond the superb science and position they were in. Number one, this is the only investment they'll need. Number two, with that investment, liquidity is 24 to 36 months away. And number three, it'll generate at least a 4x return on investment. And then
so let's go back to a 4x return on investment is what you're expecting. Just is that because you're doing a lot of the fundraising now in the public markets, so people get the valuation lift in the public markets versus the private markets, and will actually have liquidity in that?
No, actually, it's still in the private market. It's
Okay.
with the partnership with George and MDB that we now are transitioning to an even faster potential liquidity event with MDB as a partner.
So help us understand, I mean, again, for the benefit of everyone, I know MDB. I worked with you for 3 years, George, how unique your criteria is to find these companies. You're not just looking to finance anything, which I'm sure, Howard, you can opine on after George shares the criteria, what attracted you to MDB. These are unique, potentially very disruptive companies that can go into multi-hundred billion to trillion-dollar markets. But for the audience's benefit, what's the criteria for finding new opportunities, and how many can you reasonably bring to market each year?
Yeah, I mean, we were doing one deal every 18 to 24 months. So that tells you we were not spraying, praying. We were very picky on what we did. And now we're starting to scale up. And I think with Caretsu, we're looking at doing 2 to 4 a year. Although I think we could go beyond that depending on how the network builds. But our criteria is very simple. It's got to be a big idea. It's got to have a big market. We got to be able to understand kind of what Howard just said. We got to understand the value inflection points. It's got to be something that people can get their head around and understand. And we only finance leaders, and we have one of 4 title databases in the world, totally English translated for patents and IP. We're all mostly deep tech, although it's not 100%, but mostly deep tech. And we've done 17 of these in the last 20 years. And I would tell you, Lou, we're the new thing that's 28 years old. All these venture guys, a number of these private equity guys are starting to come, and angels are starting to come say, we need liquidity sooner. So our criteria
this is happening, though, right?
The right time.
It's the right time, right? It's 30
so.
Overnight success, 30 years in the making, but we're seeing that with the retail investing revolution, right? Like companies are figuring out that your IR/PR strategies of yesterday are totally obsolete. They don't work. The angel and pre-IPO investing, I think, is coming around that. And Howard, how do you see, what was the natural fit? Help for people and myself understand what Caretsu's DNA is. What is their background that's going to help you supercharge this new partnership and bring to people, and we'll put up a QR code on the screen before long, about how people can find out more information to invest in these pre-IPO opportunities by joining Caretsu.
Sure. Well, let me start by saying that I had my first toe in the water 38 years ago when I was with Safeguard Scientifics, the very first publicly traded venture fund on the planet. And it turns out that MDB has adopted and improved the Safeguard model, and it was a natural fit. From the Caretsu side, in 25 years, we've invested well over $1 billion as a group in North America in almost 1,800 companies. We do about 30 companies a year here in our regions on the East Coast. And of those 30 companies, we are pretty confident that 1 or 2 of them are going to meet the criteria that MDB is looking for. And in fact, they're looking at 2 of them right now. And we are also planning to expose our members to the MDB model and the companies that are in their portfolio as again, a way to almost guaranteed 100% liquidity based on the MDB success record over the last 28 years. Yeah. The only difference is we're going to do a lot more of them than because of the due diligence that we bring to the process as the foundation to what MDB will do. We believe sincerely that we'll be able to make that all happen. And to answer your last question, we've created a venture called IPO Angels. That's a membership group for any accredited investor who can join that will give them guaranteed access to the 2 or 4 deals that MDB selects every year as a way to increase the liquidity of their portfolio, the success of their portfolio, and so on and so forth. So that's the model. And we hope by this time last year, there'll be about 2,000 accredited investors in IPO Angels looking at these deals.
That's great. I love it. Look, I've worked with MDB, gosh, unofficially for almost 2 decades, George, and then together. And people, viewers of this show, we actually have 2 MDB names that have been incubated, brought public in our top 10 AI stocks not named Nvidia and Heartbeam, which has a cardiac device that can help detect heart attacks and arrhythmias, as well as Exozymes, which is really going to be the only proven player in synthetic biology. So there's a lot of great things to come from this. I'm really excited for this partnership, for you, Howard, for you as well, George, and everyone in the team at MDB. I would love to have you guys back on in the future as you get closer to having deals come to market. And in the interim, I'd encourage the audience, scan the QR code on the screen. You can go and get more information about Caretsu, the forum, as well as the IPO Angels. And if you qualify as an accredited investor, you can possibly put on this list to participate in these names. I'll be keeping track of what you guys are doing. Would love to have you come back on the show if you're up for it.
Thanks, Lou.
Look forward to it. Thank you, Lou.
Thank you, gentlemen. And thank you all for tuning in. We've still got more show to go, including a couple new AI stock picks that we haven't included in our top 10 list. So please stay with us for the last 10 minutes. It seems to be the best, in my opinion. We've even been playing a game that you might not be aware of, but we'll reveal the details of that game and who won before it's too long when we come back from this break. And I don't know, maybe you should pay attention to some Easter eggs. You might see a Sasquatch on the next screen.
I think the big issue that I have in this particular instance is ultimately we want these businesses to thrive and we want workers to make more money. And $7.25 is not a livable wage. We need everybody to have a livable wage for the environment that they live in. In Olathe, Kansas, it doesn't cost $30 an hour to survive. A business needs to survive. In New York, it probably takes more than $15. Let the market sort of dictate how it all works.
The free market needs to, I mean, at face value, this sounds like a wage floor, sounds like a great idea, but it's really a trapdoor for the workers, as we've espoused here. It's going to lead to higher prices. But even more important, you said it in the intro, the rise of automation, right? Businesses are dynamic. CEOs have to adjust. Every 10% increase in wages, we see a 3 to 5% increase in automation and robotics. We look at these service industries. I mean, countries like South Korea don't have any people that man the registers, right? It is absolutely fully automated. That can happen here like this. We shouldn't make it happen faster. I think, as Marcus was saying, we have to create opportunities for people to make more money, a livable wage. Minimum wage is not a livable wage. We have to give them.
Well,
Don't head out to your polka dancing club just yet, folks. We got 8 minutes to go and a few stock picks to come in a section of our show that we like to call the high five, when my friend and foe and fellow compatriot... Foe. Yeah, sometimes you're my foe. You make fun of me. So, I mean, we got to be honest.
That's where I feel most comfortable, Lou, is making fun of you.
I know. You told me that beforehand. You said, you feel most comfortable on air when you get to make fun of me. And, that's part of our be humble or be humbled. You're here to keep me humble. So I appreciate you for that.
Well, this is, show must go on. It's been a little tough going here, but, still great insight, great information.
Listen, we got plenty of people watching us online, and we got to make sure you can jump in the conversation at any time. So we've still got a little bit of time for you to change the direction of this show. So don't be afraid to join the conversation, whether you're watching us live on X, LinkedIn, or YouTube. We used to fumble and be on Rumble. Shorts causing technical difficulties. Jose Cervantes, I agree with you on that, my friend. I even was going to share out. It was a cyber attack. Opendoor bullies after us. It seems fishy to me as well, Larry Peterson Jr. I'm the third, Junior. Is there a third in your world? Hey, here's the thing. I will admit this. There are shorts that are now questioning. Even Martin, I can't even pronounce his last name, Shrekel, I just don't even want to give him the airtime, right? This is the way I think about this. And this is what I love about Eric Jackson, because I've had this in microcap names that have gone on to be mega cap names. Conviction matters. Eric's done the work. If you watch him in all formats, he knows how to handle it, right? He's like, hey, I've done the work. My thesis is sound. The shorts, they just have to create confusion and hopefully scare people out of it, but they're not going to scare Eric Jackson out. They're not going to scare me out of those shares. The fundamental model is there. The Fed's going to cut later this month. So, yeah, shorts be sneaky and might be messing with our feed, but we'll fix that for next time. We'll come up with some new cybersecurity to prevent those attacks. Let's get to the high five before we run out of time and get to those stock picks, my friend. Shall we?
Let's do it.
All right, we're back. This is like part of the interruption. You're going to ping me. I'm going to hope that I remember with all the confusion today what these topics are.
You think you got it today? You got it. There's only 5. You got it.
All right.
All right. First one, Google me.
Yeah, don't Google you. Why am I going to Google you? Google me.
You're not going to find
sue
anything,
me. I'll sue you, jerky boys. Listen, Google me, because if you remember back in April, this was a wildly unpopular stance. I was telling people to buy Alphabet because I was on Fox Business on this show saying it was dramatically undervalued relative to all the other players in the Mag 7. And I thought this cartoon summed it up perfectly. Which line were you in? Google at 145 or Google at 225? Well, folks, hopefully some of you joined along for the ride in the contrarian play, because when everyone thinks alike, as Humphrey V. Neal said, everyone is likely wrong. And they were dead wrong about Alphabet. Now shares are playing catch up, but I got news for you. They still have got room to run. So look, this is an AI pick as well. It wasn't in our report. This is a bonus pick. They've got 2 more coming here, but Alphabet's not done yet. Mark my words, this stock can go higher from here. So Google it.
All right. Getting chippy.
Yeah, getting chipping. This is where the AI chips come in, right? We talk about AI trend in 2 ways to invest: the chip providers, the pick and shovels, but then also the solution providers. And if we look from Futurum Group here, their latest research out about the top 10 data semiconductors and their exposure, you see there's a king of the hill in Nvidia, undeniable, and then TSM, which are 2 companies that I personally own and we've talked about before. But here's what I want to put your attention to. Look at Broadcom and look at ARM. ARM is a player that has not traditionally been in AI and in data centers, but they have a unique business model that is completely royalty-based. They come up with the IP, the chips get made, and they collect royalties. This is going to be an up-and-coming player. I expect them to move far to the left and up in terms of revenue generation. And then Broadcom, if you listen to the latest quarterly call, they're not talking about a slowdown in AI demand. They're actually talking about an acceleration. So that ticker symbol is AVGO, Avago, because it traces its roots all the way back to the RF front end filters for your smartphone days. But now it's a multiplayer in all of these areas of chip production. And then ARM Holdings, ARM.
It's been a lot more talk about ARM. I remember you hear a lot about ARM in the media.
Yeah, so, a lot more, and I think it's going to be a big name that you're going to hear a lot more about. So you heard it here first, or not really. There's plenty of people talking about it, but you heard it here first that these are great plays to be playing this next leg of the AI boom.
All right, what's up, Doc?
I don't know. What's up, Doc? We going to Looney Tunes?
There's something here with a rabbit. Yeah, maybe the rabbit had something to do with our sound today.
Yeah, maybe the rabbits chewed our transmission lines. Who knows? Listen, we talk about this AI trend, and we just talked about the chip side. Now let's talk about the solution side. And there's an area of this world that is ripe for disruption if we look at how many physicians we have in the world and how many administrators we have in the world in terms of medical care, right? Look at the growth in administrators in the medical market. Do you think these paper pushers are really needed? I mean, how many people realize when you go to the doctor, they still primarily communicate through fax? Like, yes, it's not a lie that 40% of medical records are still not digitized. There's a huge room for improvement. There's companies out there that are really playing off of this trend and this possibility in revolutionizing and digitizing healthcare. One to look at is Doximity, DOCS. Here's another stock pick that I didn't even anticipate sharing. So now we're at Alphabet, Doximity, ARM Holdings, and Avago. That's 4 for this episode. Let's see if we can match the track record of Eric Jackson. Probably not, but we'll do better than as good as we can. Double digits, and I'll take it. So Doximity, you look at this, it's coming off a nice bottom in the April lows here. This is a name that should be in your portfolio, or at least on your watch list for sure, as a disruption of AI in healthcare makes its way through the system.
When's the last time you actually faxed something? Is that still happening?
I think it is. I know dial-up closed down. AOL officially ended dial-up, so you got to go get rid of your AOL email address, my friend. It's over.
Yeah. Well, luckily I gave that up last year, but
that and your MySpace page are gone.
Yeah.
It's over.
It's electric.
It is electric. It's not boogie woogie.
This has got to be data centers and power. We're talking about.
It's wedding season, so it's just cheesy songs that everyone's going to dance to. No, you're right. It's data center and power. This shows that we've been talking about this so much because you're actually remembering it. Folks, this AI trend is not happening without power, right? Forget the chips. There's plenty of chips that will be provided. This is total global data center power usage between now and 2035. All you got to see is, doesn't matter what area of the world you're in, power usage is going up and to the right, which means there is going to be a global energy play here, that oil prices, all forms of energy, are going to have to go higher to meet this demand. We're going to focus on that in 2 weeks' time. We're going to have 2 energy experts, including my boss and the CEO of Prairie Operating Co., but also Josh Young of Bison Insights. So stay tuned. That's going to come on September 22nd. We're going to get into the specifics on very compelling plays in the energy market, not just prop, which is my employer that I work for, full disclaimer, deeply conflicted, but really the energy space on how do we play this? Small modular nuclear? Do you get into natural gas? What about solar and wind? Because we're going to need all of the above, and there's going to be great investment opportunities there.
All right, last one, Lou. Contrarian alert.
Yes.
What is this about?
Hey, I said it earlier. One of my favorite quotes, The Art of Contrarian Thinking from Humphrey B. Neal. When everyone thinks alike, everyone is likely wrong. I think they're about to be wrong in, drumroll please, what's the chart? What are they going to be wrong about? Any guesses, Dodd?
Gold.
No.
No, I see gold.
Gold is expensive if you look at this chart. Look, the historical correlation between gold and commodities, so all types of commodities, but if we put this chart up for just oil, it would show a huge divergence here as well. So again, this gets into that energy theme. It's getting really extreme, the divergence between gold and commodities. If you look at the gold to oil ratio, it's at about 50 times. So 1 ounce of gold would buy you 50 barrels of oil. The historical average is about 16. So what does that mean? It means that gold's either overpriced or oil is dramatically underpriced, or a little bit of both. And I'd tell you that it's a little bit of both, but more that oil is underpriced. Gold's up for understandable reasons, right? We have the money printing machines running nonstop, deficit spending that's going uncontrolled. It's an inflation hedge, purchasing power, preservation. That's the old gold bug model, and the reason that they're finally celebrating, because gold is going bonkers in this market. But oil is sitting there hovering around $60, $63 a barrel, has dipped below 60. I think we're in store for 75, maybe 80 in the next 6 to 12 months. We'll see. So the contrarian in me gets excited when I see a divergence this extreme, because it sets up really easy profit opportunities. So like I said, September 22nd is the episode. So tune in. We're going to bring you some contrarian but compelling energy opportunities.
Now's the time to buy some Prairie, right?
Prairie, and there's plenty of other energy names out there.
And a whole bunch of
look,
others,
I would tell people, if you haven't done individual stock analysis, go buy the XLE. This is the ETF that allows you to own 20 of the top energy companies. It's 20 or 23 that are in that ETF. That's the ticker that I would be paying attention to. Energy has the lowest weighting in the S&P 500. It's the cheapest sector in the S&P 500. So I've found in my 20 plus years of investing, it's hard to go wrong when something is cheap and hated, but critical, right? You can't get around it. I mean, Dodd, if I look around the room, look around your room, there's probably 6,000 products in our easy site that were made through the use of fossil fuels. So there's no way of getting around using oil.
Absolutely, man. Well, I want to end the show. I want to congratulate you. Even with all the craziness, you did pretty well. You know, on the secret game we have going here.
Yeah, that's right. Lose clues. People, you got to know that we started this game maybe in the mainstream media where someone would give me 5 words that might be challenging to say live on air and work them into the conversation, sometimes forced, sometimes not so forced. Did I get them all today?
You did. You got them all right. You got them all on there.
Well, listen, if anyone's got any ideas, stocks you want us to take a look at, if you want us to have certain guests on or me to say some random words on air, email them to Dodd. Not Lou, DODD at thebigskinny.com. We had Violator 2020 screaming your name. I don't know where that one's going, bro.
Where's Pookie?
Oh, yeah, that's Where's Pookie's Revenge isn't with us today. Listen, we love and appreciate all the attention and you tuning in, even when we have technical difficulties. We're really excited for next week's episode, which, hey, look, we went from Nvidia week to now. It's Fed meeting week, and we've got 2 blockbuster guests lined up to join us next week. First up is James Fishback right? James Fishback from Azoria Capital is the man who sued the Federal Reserve to open up the Fed meetings. He's continued to file amicus briefs against Lisa Cook, the Fed president that let's say allegedly got caught with mortgage fraud. In addition to him, we have Mike Alfred coming in, who actually is on the board of directors of IREN. So Mike is the founder of Alpine Fox LP, a lifelong tech entrepreneur, investor. Now he's a board member. He runs ultra marathons, so he's way fitter than you and I, Dodd, will ever be. Really looking forward to that conversation as well, because he's dialed into that energy demand and usage need for this AI trend to take off. Going to give us some unique insights into that overall trend, individual names he's invested in, obviously in IREN as well. So we're trying to round out the mosaic and the perspectives that we get on all these names so people can have conviction on buying the stocks that we bring to their attention on this show.
I need to let you know, I ran a half marathon once by accident.
By
Sorry
accident.
for another day. It was a full accident. We don't have time today, luckily.
No, we don't have time for that. But folks, thank you for making time to join us. Make some time to go to thebigskinny.com or scan the QR code on your screen to sign up for our newsletter, where we serve up the investment insights, one headline, one chart, and one idea to buy right away. So thank you again. We'll see you next week live from Brooklyn with thebigskinny.com with Lou Basenese. Signing off.